$900 billion, gone in a single Friday session. Not across a week, not across a month, one day. And the most chilling part is not the number itself, it is that the number arrived exactly when it was designed to. Markets closed, weekend, no reaction possible, no exit available. That is not coincidence. That is choreography. And if you understand what that timing means historically, what it has always meant when the largest financial shocks arrive precisely as the gates lock shut, then you already understand that what happened this week is not a market event, it is a civilizational signal. Oil posted its largest weekly gain since 1983. Silver got rejected at $85 multiple times and still could not close above it. And simultaneously, the Strait of Hormuz is functionally sealed, $900 billion evaporated from equities. And ground troops are being discussed in private conversations that are somehow not private anymore. Every single one of those facts is load-bearing. Remove one, and the story collapses. Keep all of them together, and the picture that emerges is not just uncomfortable. It is a mathematical certainty. This exact sequence has played out before. Not once, not twice, 3 times in recorded economic history. And every single time, the empire holding the reserve currency at the center of the disruption did not recover. Not opinion, pattern recognition. Before we go any further, understand something about the weekend timing of this story. There is a documented behavioral pattern across every major geopolitical flashpoint of the last 40 years, where the most consequential developments drop after Friday close. The Strait of Hormuz closure. Iranian missile salvos IRGC openly daring U.S. Navy ships to move through. Ground troop discussions at the policy table. The U.S. announcing a $20 billion insurance backstop just to keep tankers moving through that corridor. All of it lands Saturday morning when you cannot move a single dollar in a brokerage account. That is not how organic news breaks. That is how pressure is managed. The insiders who move first are already positioned. The retail investor reads the headlines Monday morning and reacts into a tape that priced all of this in the moment the weekend started. You cannot unsee it once you recognize the structure of it. And once you see the structure of it applied to today, you realize it is the same structure that preceded the most catastrophic financial turning points in Western history. Let us go back, not far, not into abstract theory, into documented, verifiable, empire-ending history. Because this is not the first time a global superpower watched its reserve currency status erode while simultaneously fighting a war it could not afford, suppressing inflation it could not control, and watching its population believe the system was fundamentally stable right up until the morning it was not. The Roman Empire did not collapse in a battle. It collapsed in a counting house. By the 3rd century AD, Rome had debased the silver content of the denarius from roughly 90% purity down to less than 5%. Every time the empire needed more money to fund wars on multiple fronts, to pay the legions, to maintain the infrastructure of dominance, it simply diluted the coin. The population did not understand monetary mechanics. They understood that bread cost more this year than last year. They understood that savings accumulated over a lifetime were buying less and less. Rome told them it was temporary. Rome told them the empire was strong. Rome told them the external threats were being handled, and Rome was lying, not always deliberately, but systemically, institutionally, architecturally. The machine of the empire had become structurally dependent on debasement. It could not stop without collapsing the military. It could not continue without collapsing the economy. There was no exit. The spiral completed itself. Verified. Move forward roughly 1,000 years to the Dutch Empire at its apex. The Dutch ran the most sophisticated financial system on earth in the 17th century. The Amsterdam Exchange Bank was the reserve institution of the global economy. Dutch merchants financed wars, underwrote voyages, and built the first modern bond market. And then they got pulled into sustained military conflict, first against England, then against France, then against the compounding costs of defending an empire stretched across 3 continents. Debt accumulated. The bond market that had funded the empire began funding the empire's funeral. The smart money left, not loudly, not in a dramatic single event. Dutch capital flowed quietly into English institutions, into London, into the emerging financial infrastructure of the next empire waiting in the wings. By the time the Dutch population fully understood what had happened, The center of global financial gravity had already moved. The guilder never recovered its reserve status. The Amsterdam Exchange Bank closed, and the Dutch, who had been the wealthiest per capita population on Earth, spent the following century watching their empire evaporate one bond default at a time. Move forward again to the British Empire, the most recent holder of global reserve currency status before the dollar. Britain emerged from the Second World War technically on the winning side and functionally bankrupt. The Suez Crisis of 1956 is the precise moment historians mark as the public death of British reserve dominance. But the structural death happened in 1944 at Bretton Woods, when the dollar formally replaced sterling as the global settlement currency. Britain had spent 2 world wars defending an empire it could no longer afford to hold. Its gold reserves were depleted. Its debt-to-GDP ratio had exceeded 250%. And crucially, the United States, its supposed ally, used the Suez moment to make absolutely certain that Britain understood the new hierarchy. When Britain and France moved militarily into Egypt without American approval, Washington threatened to sell its sterling reserves and collapse the pound. Britain stood down. Empire ended. Not in battle, in a currency threat across a telephone line. Same pattern, same sequence, same outcome. An empire at the center of the global financial system fights a war, or a series of wars it cannot afford. It debases the currency or accumulates debt to fund the conflict. Inflation begins to erode the purchasing power of the population. The smart money quietly repositions out of the empire's currency and into whatever asset class or geography represents the next store of value. And then, before the general population has processed what is happening, the transition is already complete. The empire is left holding the institutional structures of dominance, the military bases, the reserve currency designation on paper, the seat at the head of international tables, while the actual economic gravity has already shifted somewhere else. We are not at the cliff, we have already walked off it. The only thing still in motion is the looking down. Now apply that framework to today. Right now, this week. Oil at $91.50, up 66% since December. The largest weekly gain since 1983. Do you understand what 1983 means in context? That was the year the global oil market was still digesting the Iranian Revolution, the Iranian Revolution, the second oil shock. The geopolitical architecture that drove that move is structurally identical to what is happening right now, except this time the disruption is not regional. It is targeting the single most critical choke point for global energy supply. Roughly 20% of global oil supply is currently offline. The U.S. Treasury has deployed a $20 billion reinsurance backstop through the Development Finance Corporation, specifically to incentivize tankers to move through the strait. Read that sentence carefully. The United States government had to create a $20 billion financial incentive program just to convince private insurers to cover ships passing through a waterway that supposedly remains open. That is not a sign of stability. That is a sign that the private market has already priced the risk of that corridor as catastrophically high. The tape is reading $95 as the next objective. The September 2023 high is the level, $4 away, and if the strait remains functionally closed with conviction, the $100 conversation does not need to be forced. It arrives on its own arithmetic. Here is the inflation math you need to hold in your head. Every $10 move in oil adds approximately 20 basis points of inflation pressure to the broader economy. Oil has moved from the mid-$50s to $91. That is already more than a full percentage point of additional inflation baked into the pipeline before any secondary effects, before freight costs, before fertilizer prices, before the food supply chain consequences of 99% of ships not moving through that corridor. The Middle East is deeply reliant on food and water imports. If this disruption extends from days into weeks, the arithmetic of regional food scarcity becomes not a possibility, but a certainty. And a regional food crisis, stacked on top of an active oil shock, stacked on top of a full-scale bombing campaign, is a combination that historically does not resolve through negotiation. It resolves through escalation or through collapse. There is no gentle middle path when those three variables are operating simultaneously at full intensity. Layer that onto the Federal Reserve's position. The Fed is sitting in a sealed room. Raising rates into a supply-side oil shock does not reduce oil prices. It does not reopen the strait. It does not stop missiles. It simply crushes domestic demand and employment while doing nothing to address the inflation source. Cutting rates in this environment pours gasoline onto an inflation fire that is already being fed by the largest oil disruption in 40 years. There is no policy lever available. You cannot rate cut your way out of a military conflict driving supply destruction. That is not a theory. That is arithmetic. And the Fed knows it, which is why the language coming out of Washington right now is not the careful, calibrated language of central bank management. It is the language of improvisation under pressure. Now, let us talk about the equity market, because $900 billion in a single session is not noise. The S&P, the Nasdaq, the Dow, the DAX, all closed lower on the same Friday. Bitcoin dropped under $68,000, and here is the data point that almost nobody is discussing in mainstream coverage. The S&P 500's trading range through the first 41 trading days of 2026 was the narrowest on record going back to 1928, tighter than any comparable Dow Jones range recorded since 1896, 130 years of market history, and this specific level of compression has never been observed. During the 2008 financial crisis, the index swung within a range roughly 1,200% wider than what we have been seeing. During the COVID pandemic collapse, 450% wider. When you compress a spring that tightly for that long, the energy stored in that compression does not disappear. It waits, and when it releases, the violence of the move is proportional to the duration of the suppression. Suppressed systems do not heal quietly. They break, and when they break all at once, in a direction that maximizes the number of people caught on the wrong side of it. Now, silver, because the physical market is telling a story that the paper price has not yet agreed to tell. And that gap between them is the single most important signal in this entire setup. COMEX total silver inventory dropped to 349 million ounces as of Thursday's update. Another 2.2 million ounces drained in a single session. Multiple vaults hemorrhaging simultaneously. Over 51 million ounces left COMEX in the last 30 days, a 12.9% decline in 1 month. Registered silver, the metal actually available to settle futures contracts, sits at 81 million ounces, against a leverage ratio of nearly 7 to 1. That means for every single ounce of physical silver available for delivery in those vaults, there are nearly 7 ounces worth of paper contracts written against it. 7 claimants for every 1 ounce. The drain does not stop because the paper price is not moving fast enough to ration what is physically left, metal held in eligible inventory, stored but not available for contract settlement. Dropped an additional 2.7 million ounces in the same session. That metal is not being repositioned within the system. It is leaving the system entirely. And the mechanism that resolves this discrepancy between physical drain and paper price has exactly 2 possible outcomes. Either metal flows back in, which requires a price high enough to make delivery profitable, or price moves sharply higher to ration the access to what remains. There is no third option. Mathematical certainty. Silver closed Friday at $84.60 after rejecting the $85 level 2 and 3 times through the session. Shanghai spot at $96, a $12 premium between Eastern physical demand and Western paper price. The dollar weakened and silver still could not close above $85. Gold showed more relative strength, closing at $5,170. The frustration of the Friday tape is real, and the bear case deserves honest acknowledgement because positioning without understanding the opposing forces is not analysis. It is wishful thinking. The COMEX leverage ratio means a coordinated paper sell-off can suppress spot price regardless of physical tightness in the short run. War headlines are chaotic. Even a rumor of negotiation can trigger algorithmic selling across all metals within minutes. The margin cut on COMEX silver makes holding a paper short equally cheap as holding a long, which removes one natural source of upward pressure. None of that changes the structural foundation underneath, but it can delay the tape, and anyone watching this needs to understand those forces clearly rather than be surprised by them. China's role in this story has acquired a new dimension this week. U.S. intelligence is suggesting China may be moving to supply Iran with financial assistance, spare parts, and missile components. Whatever the geopolitical interpretation, the practical consequence is singular. There is no clean resolution path, no quick reopening of the strait, no normalization of tanker routes on any near-term timeline. And China has already implemented export controls on silver-related materials. Two entirely separate storylines. The military support angle and the industrial supply control angle are converging on the same physical supply constraint from two different directions simultaneously. That is not coincidence, that is strategic positioning. And the entity doing the positioning clearly understands where the value is going. Here is what collapse actually looks like for the person watching this video, from a living room somewhere, filling up a car, buying groceries, checking a bank account balance. It does not arrive as a headline. It does not arrive as a dramatic single-day event that everyone agrees is the moment. It arrives as a slow, grinding series of individually explainable price increases that compound into something the paycheck cannot absorb. It is the ATM that dispenses cash, but the cash buys 30% less than it bought 18 months ago. It is the gas station price that changes 3 times in a week. It is the grocery store where the packaging gets smaller and the price stays the same, and then the price also increases. It is the mortgage rate that moved before you could refinance, and the rent that moved because your landlord's costs moved, and the insurance premium that doubled because the actuaries already priced the risk you haven't seen yet. It is the savings account that technically has the same number in it, but that number represents a fraction of the purchasing power it represented when you put the money there. That is what $10 oil moves feel like at the household level. That is what a 12.9% monthly drain in physical silver inventory means when it eventually reconciles with the paper price. That is what a $900 billion single-day equity wipeout means when it is the opening act of a compressed spring releasing after the tightest trading range in 130 years of recorded market history. You can't unsee it, not after you connect all of it together in sequence. But here is what the coverage rarely explains. Every empire transition, every currency collapse, every moment when an old financial system begins to break apart has never been only about destruction. It has also been the largest transfer of purchasing power in human history. The pattern repeats again and again. Those who held real assets, things no government could print and no central bank could create with a keystroke, came through the collapse, not only protected, but wealthier relative to everyone around them. Romans, who held land and physical silver, survived the debasement of their currency. Dutch merchants, who moved capital into English assets before the Guilder crisis, multiplied their fortunes. British families who shifted sterling into gold and dollar assets before the Suez collapse preserved their purchasing power. Same pattern, same outcome. Today, the signals are visible in real time. Capital is moving out of paper promises and into things that are finite and real. Gold, silver, land. Assets that exist outside the financial system itself. You are not early, but you are not late either. History shows that the most dramatic repricing happens during the final recognition phase, when the public finally realizes what has already happened to the currency beneath them.